I'm very clear that, and I could be very horribly wrong, but my sense is same time next year you're probably going to see a rupee of 45, 47 to the dollar, and not 55, 57 or 60 or 70 or 100 as a lot of people as a knee-jerk reaction have been predicting. Because the data doesn't show any weakness in the rupee. I mean, I'm at a loss to figure out why the rupee at all should be at 52, 53, or wherever it was a couple of weeks back. Now it's a little bit stronger than that. Because, on the current account, we are very comfortable. We are only 0.5% of GDP as a deficit if we exclude gold. And I exclude gold in current account because that is a misclassification. Gold is a capital account transaction because gold you take into your investment account. It's not the same as oil, which is consumed. So an investment account transaction has to be a balance sheet transaction. Balance sheet transaction is a capital account transaction. So if you take gold out of the current account, the current account deficit is hardly $8 or $10 billion at the highest, which on a $1.5–2 trillion economy is 0.4, 0.5, 0.6%. That is extremely comfortable. And if you have coupled with that situation a weak oil this year, as I anticipate it will be, even if you have a correction of 20% in oil, okay, so $130 billion oil bill falls $20–25 billion or thereabouts. You're looking virtually at a current account surplus excluding gold. And on the capital side, things are looking very, very good. If you look at FDI, we have had the best year of all time in FDI. I think we'll end the year with anything between $25–35 billion in FDI, take an average of 30. That's the highest we've seen of any point of time in India. And I think that's cumulatively probably 2.5 times the last 3 years total. So where is the cause to think that the rupee will weaken? If you look at the deposit side coming in from overseas, the liability side, that's very strong as well with the freeing of the NRI numbers. So I think overall on the BOP we'll have a comfortable surplus. When you have a comfortable surplus on BOP, I see no reason why the rupee should be at 51, 52. And the joker in the pack is the FII side, okay, which has been very, very small. But if the rupee were to actually strengthen by 4 or 5%, let's say go to 50, you will see a lot of capital flowing in even from the portfolio route. Although I don't respect that route as much as I respect FDI, we'll take it. So it's reflexive. The more the rupee strengthens, the more people get interested in buying up stock. If the markets are down, rupee begins a strengthening cycle. Suddenly you can have 3 good months in which you get $5–10 billion from FIIs. If you put all that together, you're looking at a very comfortable capital account. The current account looks, in my view, extremely comfortable. Why can't I make a case for a 45 rupees on the dollar?
So to your mind, the current environment is actually an opportunity for Indian investors?
My view is the current environment is good for buying a handful of stocks. I don't think it's good enough to take huge amount of risk, but to buy a good stock, which is corrected 20–30% without any huge cut in their fundamentals, I think this is as good a time as you'll ever find to go out and buy those stocks.
You liked autos in the past, Bajaj Auto, Hero MotoCorp to some extent. Do you still like autos?
Autos are still our number one bet. I mean, if you think about it, despite all the pessimism, auto sales have been still quite okay. I mean, CVs, if you had to believe the -5% IIP number of, was it October or November, CV sales shouldn't have been up 5 or 6% for the year, but they are. Two-wheeler sales shouldn't have been up 17–18% if the situation was so bad, but the fact is that they are. So overall, I think the data itself needs to be sort of questioned rather than the macro fundamentals of a lot of industries. So overall, I'm quite optimistic about autos.
Why do you like two-wheelers? Because if I look at the market dynamics for the two-wheeler industry, competition will increase, the base effect will kick in, and somewhere I guess the demand also may slow down.
I think India is a very under-penetrated market in autos. If my data is correct, I think the overall vehicle population in India is, including two-wheelers, is about 14 crores or 15 crores at the highest. Okay, so that's just a 10% penetration. And two-wheelers would be about 80% of that. So you're only about 1 or 2 crore cars by way of population on the roads. And that's like 1 or 2% car penetration in India, and a 12–13% two-wheeler penetration in India. When you're talking 75% penetration in mobile, why can't you argue that every person who owns a mobile at some point will also own a two-wheeler at least, forget a car. Okay, it might not happen in 2 years, but I think the long-term trend that, 10 years out, will vehicle population in India not double from here? I think that's a silly call to make. I think it definitely will, if not do better than that. So just look at the macro numbers. You have to be enthused that, India's still a long way away from even reaching standards of, other third world countries. So if you're looking at a 30 crore vehicle population a few years out, you have to only take the bet that which are the companies which will constitute most of this growth. As long as you're right on that. And I don't think competition is increasing per se. I think everybody who is meaningful is already here. It's a well-penetrated market, at least on the manufacturing side. There's hardly any global major who's not here. So everybody is here. The entrenched guys have their market share. The smaller guys will do a little bit to gain market share. But by and large, I don't see a dramatic realignment of market share. Okay, so as long as that thing remains, you're looking at an industry which is still very nascent, very, very nascent.
But within the auto space, you like Bajaj Auto versus Hero MotoCorp, and within the four-wheeler space, the house view is to buy Tata Motors, not Maruti. What's the thinking behind this?
I'm not saying don't buy Maruti. I mean, we like Maruti. It has had its problems, the other twin problem of obviously the labor issue, as well as one of the bigger problems of having a high market share. So when you have 50% market share, you almost end up losing rather than gaining from that. It's like a AAA bond. Not to say that I believe what the rating agencies say about AAA bonds, but taking it at face value, AAA can't become 4A. It can only remain AAA or become AA or lower. So a 50% market share is almost a certainty that they will give up some market share. And that's really what has happened if you see in the last
gone from
years.
65 to 42.
Correct. So that was the other problem with Maruti. But I don't think it's a company that will go down to 30% or so. I think it's a very efficient company. And at 900 or 950, I think it's a reasonable bet to take on. So I'm not bearish on Maruti. I'm bullish on Tata Motors, but that's not to say that I am, as the other end of the seesaw, bearish on Maruti.
But you are bullish on Tata Motors because of the JLR business, not because of the passenger cars they are making or because of the trucks they are manufacturing.
No, I have argued against the fact that they should at all be in domestic passenger car market. I don't think they have really any edge worth the name in the domestic car market. When this started out, it was a good idea, but I don't think incrementally it looks like such a good idea. So, maybe they should revisit it from ground up to see whether they should at all be in that business. But if you exclude that, they have a damn good CV business and they have an amazing luxury end of the market business. If you just keep those two, I think this company is an absolute rocket. And even keeping the domestic car business, if you make it 8,000-10,000 crores of profits, and looking at JLR numbers the way they are shaping up, I mean, I can make a case for the stock to be a lot higher than where it is now.
Reliance was trading at a 20% premium to other commodity stocks when you initiated a sell. Now Reliance is no longer trading at a premium to other commodity stocks. Is Reliance attractive or still it's looking stretched?
No, I mean, there's no reason, again, I have found in the last many quarters that we've been negative on Reliance to change our view. Other people, I think, are now beginning to change their views from being very bullish to being negative. But our view was when it was 1100 or so, down 40%. But I doubt if that's the stock that will lead your market rally this year. I think that's going to lag the markets for sure. So if the markets rally 20%, Reliance might go to 10-15% rally from here. But I don't think it's a sustainable rally in Reliance whenever it does happen.
So which end of the market, to your mind, has potential to be the leader of this rally? Financials, materials, industrials?
Financials for sure. PSU banks in particular, really crushed, for right or wrong reasons. Markets have feared worsening of the NPS cycle, and I think to some extent it will worsen. But whether they deserve to trade at these valuations, is quite another matter. I mean, I think a lot of them look very attractive. And when you see a softening of the rate cycle, which I think could be initiated from just this month's meeting itself, if not on the rate, at least on the CRR part, that's the big trade that you will need to play. So you could make, without even getting too sentimental about them, you could easily make 20-30% in names which are pretty large and liquid.
So 2012, to your assessment, will give you the trading opportunities, and you got to go and grab them. You make your 20%, you make your 30%, get out. Don't buy and lock the stocks with the assumption that 2014, 2015 they'll be 3 times.
In my view, you should never buy and lock away stocks. So I don't belong to the Warren Buffett camp at all. That you should buy and hold and never look at the stock for the rest of your life or 10 years or something. I think that is not relevant advice anymore. Maybe that was relevant 20 years back. But in stock markets, nothing is permanent except that what is here is what I have to read and change my strategy. So I don't believe in all that kind of stuff anyway. But yeah, I mean, you will get good. I think you are already getting very good opportunities in the marketplace in the stocks and sectors that I mentioned. If you make 30%, it would be prudent to take money off the table, because we are definitely not in a situation where you can call for a huge secular bull market just yet. We like to see more evidence on the ground. And remember, if we do get into a secular bull market, if you buy something even 30% higher, it really makes no difference, because something that goes up 3 times, sometimes it is better to buy when momentum has come back into the stock or the sector, rather than be the first guy in the trade.
But is there a trade in any of the capital goods stocks? I know you've liked BHEL in the past. It's got a phenomenal track record, 0 debt. Peak P multiple was 25 times plus. Now if I look at the Bloomberg consensus, that is 8-9 times.
I mean, we've liked it. I mean, we've followed the company from, I think, the time it got listed back in the mid-90s. We've liked it on and off, but the last 2 or 3 years we've been very negative on the stock, because it was trading way too expensive for the kind of fundamentals.
But at 7 times?
Maybe we don't have a very clear mind on that, because there is a problem of pipeline in the capital goods segment overall. There is, and whether the power sector additions will be what the government is forecasting in the 12th plan, whatever it is, I think it's 100,000 megawatts or something. By whatever we learned from the sector is that we are lucky if we're going to be adding 50,000. And if you take BHEL's market share off that, because it has a reasonable market share which not that volatile, then you can't make a case that BHEL will have hugely overflowing order books, simply because the macro of its sector is probably a lot weaker than the macro of other sectors. The power doesn't look to be in great shape, to be honest with you.
So I don't want to get this one wrong for our viewers. Just to reconnect some dots here. Your big sectoral calls for the year 2012 are auto and PSU banking. It's more like a void or a sell on FMCG and pharma. What to your mind will happen to IT?
Well, it's not a sell on FMCG or pharma. I mean, so
reduce maybe.
No, it's just that they are less risky, so they are more likely to underperform a big market rally. And I suspect in this year you will get a big market rally. That's the time when actually the defensive will hurt your portfolios. It's not that we dislike them. We have liked at least pharma for quite a while now, and they have done as a pack quite okay. But the risk trade, at some point has to be initiated. I think you can get into the risk trade now, because markets at 16,000 look, reasonable at least for a bounce. Other than that, we've been negative on power for a while. We continue to remain negative on that. Capital goods still doesn't look as if it's going to have a big purple patch coming up soon, based on what we gather from the company, that order books are not looking that hot. So there are plenty of problem areas in the market for sure. Let's not get carried away and say there are no problem areas. I just think following a bad year like 2011, we are cyclically due for a rally, and I do believe strongly the rupee will strengthen, and that itself is good enough reason for the market to rally.
Right. Globetrotting was on your agenda for 2011. What is on your personal agenda for 2012?
Oh, I'm a non-resident, so I spend most of my time overseas. But yeah, I still follow what goes on here.
So what is your big call for 2012 then? Let's wrap it up.
I think a strong rupee. I think a 45, 46 rupee to dollar exchange rate is.
What could challenge your conviction?
Well, many things can go wrong in this assumption of mine, but I don't think I'll be wrong on this one.
Sharma, always a delight to have you back on ET Now. Thank you for joining us.